Hi, I'm Jimmy. In this video, we're looking at stock-based compensation and how much does it hurt shareholders, how it could affect discounted cash flow, or ultimately the fair value of stocks. We're going to use Google as our example in this video, but this would work just as well for companies like Apple or Amazon. Really, a lot of tech companies use stock-based compensation, and ultimately this can be a killer for value investors if it's not something we keep in the back of our mind when we do the research. Now, before we jump into that, let me tell you real quick, I'll give you a quick example. So let's imagine that we have a hypothetical company, and we're going to say that the fair value of this company is worth $100 million. And let's pretend that they're publicly traded and they have 5 million shares outstanding. Well, that would imply that the stock price should be about $20 per share. This is logical. But let's imagine that that company issued a whole bunch of stock-based compensation to its employees. So basically, they give those employees the ability to turn some of their compensation into new shares. Well, let's pretend that they did a ton of new shares, and instead of 5 million shares, they had 10 million shares because they issued 5 million shares in stock-based compensation. Well, automatically, that drops the fair value from $20 to about $10 per share. That is ultimately how this can be a huge killer to companies and how we as potential value investors come up with the fair value for the stock. Okay, so that's our hypothetical example. Now let's look at a real life example in Google. So these are real numbers. This is a chart of Google's stock-based compensation, the dollar value of their stock-based compensation going back to 2010. And you can see that Google's numbers are huge. So let me show you real quick about how these numbers are accounted for in their financial statements, because it's crucial that we understand how that they're accounted for, and then we can better understand how they could impact discounted cash flow calculation or something like that. So this is an actual income statement. I oversimplified it for sure, but this is an actual income statement for Google stock or Alphabet over the past 12 months. But we can actually expand some of these numbers, and we can look at the numbers behind operating expenses. Now, I bring that up here because let's imagine we're wondering, well, stock-based compensation, is that accounted for in the numbers? And on the income statement, it is accounted for. So let's pretend that you got a job at Google and you are working in their research and development portion of their business. We can see the expense in there is about $37 billion. So this is a big expense. Well, you get whatever your salary is, plus let's pretend you got $1 million in stock-based compensation. Well, when you get stock-based compensation, generally, it's not like you can buy that stock immediately today. Usually there's a vesting period. Now let's imagine that for Google, that they vest your particular contract over the next 4 years. Well, if they do it over the next 4 years, assuming you can vest 25% a year, and it's $1 million stock option, well, that would imply that $250,000 in year one is how much actual stock you can convert your stock-based compensation into actual shares. Well, that $250,000 will show up in the research and development expense from the income statement. If you worked in the sales department, well, your $250,000 would be an expense up there. So the expenses are spread out based on where the employees work. The key point for us to remember with this is that if our particular stock options vest over 4 years, well, those numbers get spread out over 4 years, however they spread them out. I've actually heard that Google front loads it, so maybe a third in year one and year two, and then less in going forward. But either way, it's spread out over multiple years. So when we go back to our chart of stock-based compensation, while yes, the numbers are certainly increasing, not all of the numbers are tied. It's not like they issued $18 billion in stock-based compensation last year. Some of that would have been from years before that are all rolling into it that are still available to vest. Now, these numbers, by the way, came from the cash flow statement. And this is very important because these expenses are on the income statement, but they're not actually cash. When you calculate free cash flow, these numbers get added back to it. That's how I knew how much was being added back in each year going back to 2010. If you pull down the cash flow statement for all of these years, this is the data that you would get. But it's very important to remember that those numbers get added back to free cash flow to calculate free cash flow because they are not actually cash expenses. So this ultimately leads us to the question is, how does this affect free cash flow and the fair value of the stock? Well, a lot of this would be tied to what is the company doing to offset these shares that they're ultimately creating. So with this chart here, well, the red bars are exactly the ones we just saw. That is the stock-based compensation. The green bars are the amount of stock buybacks or stock repurchases, you might hear them called, that Google has been doing. And you can see that it's not nearly as consistent as the shares being issued or being offered for the employee compensation program. But we can see that there's a lot more shares being bought back than there are being issued by stock-based compensation. So in this case, well, this isn't really going to hurt their fair value all that much. So when we jump over to our discounted cash flow calculator, well, the real question is, the shares outstanding that we have here, are those shares outstanding including these stock options that are being presented to employees? And it's not. Just like it's not including the shares that could be being bought back in the future. And I actually think that this is a much more logical way to go for, a much more logical way to calculate the fair value, because an interesting part about stock-based compensation is, going back to the example before, you get a job at Google, and let's pretend Google's trading at about $100 a share, and you get the option to buy them at $75 per share. What if the stock falls? The stock is down a whole bunch over the past year. What if the stock falls? Well, you know what you're probably not going to do? You're probably not going to turn your potential shares into actual shares. Why would you convert them into shares at 75 if they fall to 60? So it's possible that some of these shares do not get converted into actual shares. Plus, we're also not accounting for the fact that Google is buying back some shares. Now, I think the most important thing for us to do, or for us to consider when considering stock-based compensation and its potential impact on our investment, is analyze how much stock-based compensation do they have out there, and is the company buying back shares? A company like Google, a company like Apple, well, yes, they are issuing stock-based compensation, but they're buying back more shares. So at the end of the day, that will actually favor the average value investor. So this is a good thing. But if a company is issuing a whole ton of shares, a whole bunch of stock-based compensation, but not buying back any shares, well, that could be the silent killer that people aren't really paying attention to. They're not paying attention to until they realize, oh my God, look at how many extra shares are around. Why are the stock prices falling? Because there's so many shares out there. Now, if you're curious to see the Google video that we recently did, I will leave a link right here. And if you'd like to sign up to get access to this website, you get access to the discounted cash flow calculator, and we do a few live streams each week for our private investing community. If you'd like to sign up, I'll leave a link right here, link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.